Welcome back to the deep dive. This is where we take a whole stack of sources, research, data, everything we can find, and try to boil it down into something clear, something you can actually
Yeah,
use.
cut through the noise.
Exactly. And today, we're really digging into a company that's, well, it's absolutely critical to, flying, defense, everything, but maybe doesn't grab the headlines every day. Howmet Aerospace Inc., tickers HWM.
Oh, how it's fascinating right now. I
Yeah.
mean, intellectually, it's one of the most compelling industrial companies out there, I think. It's a real case study. You've got this almost perfect internal execution. Their operations, their margins, incredible.
Right.
But then externally, it's chaos. Their actual growth, their top line is basically being held hostage by things totally outside their own control. It's quite the dynamic.
That tension, that's exactly why we wanted to tackle this today. It's the core of it. So our mission really is to unpack the sources, look at the evidence for Howmet's really strong financial performance, understand where their competitive strength comes from, that famous moat, and then we have to confront that central risk, the big one, that makes their valuation, well, let's just say premium, look a bit complicated. How does this internal engine keep running when its biggest customers are, frankly, sputtering?
Yeah. How do you manage that disconnect?
Okay, let's unpack this.
Right. So to really get Hammond today, you kind of have to rewind a little bit, but not too far. Back to April 1st, 2020. That's when the company, as we know it now, was essentially born. It separated from the old Arconic Inc.
Which was a much bigger, more sprawling kind of company.
Exactly. Much larger, much more complex. And that separation, it wasn't just, slapping a new logo on the building. It was fundamental.
A strategic purification, I think I saw it called.
That's a great way to put it. Purification. Because the sources are really clear on this, the split-led Howmet basically ditched the lower margin stuff, the commodity aluminum businesses that were dragging down the overall performance. It was like cutting loose an anchor.
So it sharpened the focus.
Totally. Sharpened it right onto the high margin, technology heavy segments. That's why their whole identity shifted. They went from being seen as this, giant metals company to more of an IP provider, a specialist in engineered solutions.
And the tech focus really shows up when you look under the hood. They talk about this strategy of differentiated technologies. Something like nearly 1,300 patents, granted and pending. That's serious R&D.
It is. And it's not just patents for patent's sake. It's all geared towards making components lighter, stronger, more fuel efficient. That's the holy grail in aerospace, right?
Less weight, less fuel burn.
Precisely. And Howmet's expertise, especially in things like advanced metallurgy, lets them make parts that others just, well, they struggle to replicate. And that specialization, that difficulty, that's where the pricing power comes from, particularly in their biggest division, engine products.
Okay, yeah, let's zero in on engine products because everything points to this being the absolute core of Howmet's value. It's about half their total revenue, something like $3.7 billion in fiscal 24.
Yeah, roughly half the revenue, but arguably much more than half the value creation because of the profitability. And what they make here is it's incredible stuff. Investment cast turbine airfoils.
Okay, break that down. Airfoils. Like the blades.
Exactly. The blades and vanes, the really intricate sculpted parts that sit in the hottest, most stressed part of a jet engine. I mean, you're talking about components spinning insanely fast, thousands of RPMs, in temperatures that are, hotter than volcanic lava. These things are absolutely mission critical. If one of these tiny blades fails,
The whole engine goes.
the whole engine fails.
Right.
Catastrophically. The tolerances, the material science, it's just on another level.
The technical challenge sounds immense. You mentioned something earlier, single crystal airfoils. What is that and why does it lead to such, well, amazing margins?
Ah, yes, single crystal. Okay, so think about typical metal. When it cools and solidifies, it forms lots of tiny crystals, right? And the boundaries between those crystals, the grain boundaries, those are inherent weak points. What Howmet does, through incredibly precise control of the cooling process, often involving like complex vacuum furnaces and proprietary techniques, is they make the entire blade solidify as one single crystal. No grain boundaries.
Wow. One giant crystal shaped like a turbine blade.
Essentially, yeah, at the atomic level. This makes it immensely stronger, especially at high temperatures. Mastering this process, it takes decades of know-how, specialized equipment. Only a very small handful of companies globally can reliably do this at scale.
And that's the moat for engine products, that technical barrier.
That's a huge part of it, and it directly translates to those margins. The engine products segment adjusted EBITDA margin. It hit 33.8% in the second quarter of 2025.
33%. On metal parts.
33%, up from an already impressive 30.8% in 2024. I mean, you just don't see those kinds of margins in traditional manufacturing. It looks more like a high-end software or pharma company margin profile. It's proof positive of that deep, deep competitive moat they have there.
That really underscores the impact of that strategic split and the focus. But the overall company's margin improvement isn't just about engines, is it? The other segments have seen turnarounds, too.
Absolutely. You can't get the whole company's margin up to, the high 20s without the other parts pulling their weight too. And they clearly targeted those other divisions for optimization. Take fastening systems.
The bolts and screws, basically, but high-tech ones.
Exactly. Not the kind you get at the hardware store.
Mm.
These are highly engineered aerospace fasteners, often made of advanced alloys like titanium, critical for holding the plane together. This segment did about $1.6 billion in revenue in 2024.
And the margin story there is pretty dramatic, too, isn't it? The sources show it jumping from, around 21% in 2023, way up to over 29% by mid-2025.
Yeah, 20.6% in FY23 to 29.2% in Q2 '25. That's a huge leap. And it speaks volumes about operational execution, tightening up processes, cost control, leveraging the volume increases they are seeing. Just really strong management focus.
Okay, and then there's engineered structures. What's the story there?
Similar narrative, really. Engineered structures makes the big, complex structural parts for the airframe itself. Think large titanium forgings, bulkheads, things like that. Historically, this was maybe a bit of a lower margin area for them,
Right.
potentially due to older factories or maybe a less optimized product mix. But management clearly put it in their sights. They focused on refining the product mix, optimizing the manufacturing footprint, and boom, the margin surged there too, hitting 21.4% in Q2 2025. Again, really strong improvement.
So engines, fasteners, structures, all showing margin expansion through focus effort. What about the last one, the outlier forged wheels? That's not aerospace.
Correct. That's the legacy Alco Wheels brand.
Uh.
Forged aluminum wheels, primarily for heavy-duty commercial trucks and trailers. It's their one main non-aerospace piece.
And that market, trucking, can be pretty cyclical, right?
Very cyclical, and we saw that. The sources show segment revenue actually declined 8% in 2024 because the heavy-duty truck market hit a down cycle.
Okay, so revenue down, margins must have gotten squeezed.
You'd think so, wouldn't you? But this is where the operational discipline shines through again. Despite that revenue drop, they maintained a really strong segment, adjusted EBITDA margin of 27.2% in 2024.
How?
Aggressive cost management, pricing discipline. They didn't chase volume at the expense of profit. It shows the resilience built into their operating model now, even in a downturn. It's a nice diversifier, and it's still highly profitable.
So putting it all together, you've got this engine powerhouse driving incredible profitability, and then these other three segments all improving their margins significantly through turnarounds and operational grit.
Exactly. And the net result is that the total corporate adjusted EBITDA margin expanded impressively, reaching 28.7% in Q2 2025. It's clear this isn't just about riding an industry wave. This is structural improvement, driven by deliberate strategic choices and excellent execution.
It really does feel like they've built this high-margin fortress.
That's a good way to think about it. A fortress designed so that when more revenue does eventually come through those gates, a very high percentage of it drops straight to the bottom line.
Okay, so we've got these impressive margins. Now, how do they defend them? Let's talk about their place in the whole aerospace ecosystem. They're deeply embedded, aren't they? Tier 1, Tier 2?
Oh, absolutely fundamental. They're a critical Tier 1 supplier, selling directly to the big airframe makers, Boeing and Airbus. And they're also a crucial Tier 2 supplier, selling components to the engine giants. GE Aerospace, Pratt & Whitney, Rolls-Royce, they're right in the middle of it all.
That integration seems key, but it's not just about selling parts for new planes, is it? There's this other piece, the aftermarket, that seems increasingly important.
Hugely important. And it's a structural shift that adds this layer of, stability and enhanced profitability. We're talking about MRO, maintenance, repair, and overhaul. Spares, essentially.
Right. And the data shows that slice of the pie getting bigger for Howmet. It went from, 11% of revenue back in 2019 up to around 17% in 2024 and heading towards 20%.
Yeah, pushing towards that 20% mark. And that shift is incredibly significant for a couple of reasons. First, aftermarket revenue is generally more stable. It's tied to actual flight hours, how much planes are flying, and the age of the fleet. Much less volatile than the new aircraft build schedules, which, as we know, are all over the place right now.
Okay, stability. That makes sense.
But even more important is the profitability. Spare parts, the components sold into the MRO market, typically carry substantially higher profit margins than the identical parts sold as original equipment, OE, for a new plane.
How much higher? Like significantly?
It can be dramatic, sometimes double the margin, or even more for certain high-value parts like those advanced airfoils. So as Howmet's aftermarket mix increases, it provides this automatic structural uplift to their overall corporate margin profile. And think about it, the global fleet of modern jets, the ones using Howmet's most advanced high-value parts, is still relatively young, as that fleet ages over the next decade or two.
More MRO demand for those high-margin parts.
Exactly. It's a built-in tailwind, almost regardless of near-term OEM production rates. It's a beautiful thing for their business model.
But that stable, high-margin stream only works if they can keep competitors out. Which brings us back to that competitive moat we mentioned. What exactly makes it so hard for someone else to come in and steal this business?
The sources point to basically three big walls.
Yeah, it's like a multi-layered defense. The first wall is just sheer technological complexity. We talked about the single crystal airfoils. That's deep material science, proprietary manufacturing processes developed over decades. You can't just buy that knowledge quickly off the shelf.
It's not something you can easily reverse engineer.
Not easily, and certainly not quickly or cheaply. It requires immense institutional knowledge, specialized equipment, highly skilled engineers, and metallurgists. It's a huge barrier in itself.
Okay, tech complexity is wall number one. What's number two? Wall number two is the regulatory nightmare, basically. Certification. Every single flight-critical component has to be rigorously tested and certified by aviation authorities, like the FAA here in the U.S., EASA in Europe.
Right, safety is paramount.
Absolutely. And then on top of the regulatory certification, the part also has to be specifically qualified by the OEM, Boeing, Airbus, GE, Pratt, for use on their specific aircraft or engine platform. This whole process, it takes years, plural, and costs millions upon millions in testing, documentation, proving reliability under extreme conditions.
So the upfront cost and time investment just to try and compete is enormous.
Astronomical. It weeds out almost everyone before they even get started. It's a massive financial and temporal barrier to entry.
Okay, tech barrier, certification barrier. What's the third wall?
The third wall is arguably the strongest for long-term revenue security, high switching costs.
Meaning once Howmet is designed in, it's hard to switch them out.
Extremely hard. Think about it. Once a specific Howmet part, say a critical turbine blade, is certified and designed into a GE engine powering the 787 Dreamliner, that part is now part of the certified design for that entire aircraft platform. For Boeing or GE to even consider switching to a different supplier for that specific part later on,
They have to recertify.
they'd potentially have to go through a whole new round of testing, certification, qualification, the cost, the time delays, the potential risks involved in introducing a new, unproven component midlife. It's just immense. It's almost unthinkable unless there's a catastrophic failure or supply issue with the original part.
So effectively, Howmet gets locked in for the entire life of that aircraft program, which could be decades.
Decades, 30, 40, maybe even 50 years, including the aftermarket stream. It turns those long-term supply agreements into something resembling a very, very long-duration, high-margin annuity stream. That's the power of the switching costs.
Incredible security. But okay, they can't be completely alone in this space. Who are the main competitors they're actually up against? The ones who've managed to scale these walls?
The big one, their primary direct rival across most of their core areas, castings like the engine parts, forgings for structures, and fasteners, is Precision Cast Parts Corp, or PCC.
PCC, owned by Berkshire Hathaway, right? Warren Buffett's company.
That's the one. Certainly not a lightweight competitor. Well capitalized, obviously. Beyond PCC, you have other players in specialty materials that overlap in certain areas, companies like Carpenter Technologies, CRS, or ATI. But PCC is the most direct, head-to-head competitor in Howmet's key markets.
Okay, wait a second. If PCC is owned by Berkshire Hathaway, arguably the most rational long-term capital allocator on the planet, why haven't they just, thrown money at the problem and replicated Howmet's success, especially those 33% engine margins? What's Howmet's specific edge here that even Berkshire's billions haven't fully overcome?
That's the multi-billion-dollar question, isn't it? And the sources don't give a single, simple answer, but you can piece together a few things. It likely comes down to a combination of maybe Howmet's deeper, more focused historical expertise, particularly in those most complex airfoil technologies that legacy intellectual capital.
The decades of specialized R&D before the split.
Possibly. And also perhaps the agility Howmet gained after the split. By shedding those lower margin businesses, they became laser focused. PCC, while huge and capable, is still part of a larger conglomerate structure within Berkshire. Howmet might be able to deploy its R&D and capital investments even more surgically onto that bleeding edge of high-temp single-crystal technology where the absolute highest margins are.
So maybe a slight edge in focus and specialized know-how, even against a giant like PCC.
That seems plausible. It's subtle, but in a game of inches like this, it could make the difference in those margin points. But look, being so critical and so integrated also comes with a major risk baked in, which we have to acknowledge.
Customer concentration.
Exactly. Being so deeply tied to the fortunes of Boeing, Airbus, GE, Pratt, and Rolls-Royce. It's fantastic when they're all firing on all cylinders.
Yeah.
But when they stumble,
You stumble with them.
precisely, any production rate changes,
Yeah.
any quality control fiascos, any strategic shifts by just one or two of those major customers can have a really material impact on Howmet's results.
Yeah.
It's the unavoidable flip side of that deep integration.
And that leads us perfectly into the core tension defining the whole aerospace sector right now, this clash. On one side, you have just overwhelming demand. Global air travel is roaring back, projected to blow past pre-pandemic levels.
Yeah, the demand signal is absolutely flashing green, red hot even.
Yeah.
The sources consistently point to this massive backlog. The combined order book for Airbus and Boeing is over 16,000 aircraft.
16,000, that's hard to even picture.
It's enormous. At the current sluggish production rates, it's more than 15 years' worth of work already lined up. So if you're Howmet looking out, you see this incredible runway for demand. Decades of potential orders. That kind of visibility is almost unheard of in most industries.
Okay, massive demand, multi-decade visibility, sounds great. But here's where it gets really interesting. That demand is slamming right into a wall. The supply chain. It's completely bottlenecked.
That's the crux of the entire situation. This huge pent-up demand is meeting a supply chain that just cannot keep pace. And crucially, the bottlenecks are mostly further up the chain, at the OEMs themselves or their other key suppliers. It's not primarily a Howmet issue, but Howmet feels the pain.
So the OEMs just can't build the planes fast enough.
They're struggling mightily. You see specific examples everywhere in the reports. Airbus has been consistently held back by shortages of engines for their best-selling A320neo family issues with both Pratt & Whitney's geared turbofan and the CFM LAP engines. They want to ramp up production, but they can't get the engines consistently.
Okay, so engine shortages for Airbus. What about Boeing?
Boeing's issues are, well, more widely publicized and unfortunately more systemic recently. Their 737 MAX production. It's still operating under a federally mandated cap imposed by the FAA due to ongoing quality control concerns and making sure their own internal processes and their suppliers are up to snuff.
Right, they're capped at, what, 38 planes a month currently?
That's the figure, 38 per month. They want to build more. The airlines want them to build more. Howmet has likely built capacity anticipating higher rates, but they simply aren't allowed to exceed that cap until the FAA is satisfied. And there have been other supplier issues impacting 787s too. It's a constant battle for them.
So Howmet is stuck in this bizarre dual reality. They can see this mountain of orders stretching out for 10, 15 years. But the actual timing of when they get to fill those orders, the pace of their growth month to month, quarter to quarter, it's completely out of their hands. It depends entirely on whether Boeing and Airbus can sort out their own production problems.
Exactly. And frankly, the track record for Boeing and Airbus hitting their ramp-up targets consistently over the past couple of years has not been great. That uncertainty is the shadow hanging over Howmet, despite their own internal excellence.
It's a key external variable.
It absolutely is. And it's probably the main reason why, despite stellar execution, the valuation hasn't gone even higher. But it's important here to remember Howmet isn't just commercial aerospace. They've got other drivers that help smooth things out a bit.
Right, diversification. Let's touch on those. First, the defense market. That's usually pretty stable, isn't it?
Generally, yes. Especially right now, with elevated geopolitical tensions around the world, defense spending is up globally. The sources mentioned the proposed U.S. Department of Defense budget for 2025 is around $850 billion.
That's a huge number.
It provides a very stable, reliable backdrop for Howmet's components that go into military aircraft, like the F-35 fighter jet engine and airframe parts. Defense demand tends to be less cyclical than commercial air travel, sometimes even counter-cyclical. It adds a nice layer of predictability.
Okay, stable defense demand. But then there's this other area, industrial gas turbines, or IGT. That seems like a really interesting, almost non-correlated growth story.
It's becoming a really powerful secular trend for them, and it ties back to that same core expertise in high-temperature metallurgy.
How so? What's driving IGT demand?
Data centers,
That-
cloud computing, artificial intelligence.
Mm-hmm.
Think about the massive sprawling data centers being built everywhere to handle cloud storage, streaming services, and especially the huge computational demands of AI training and inference.
They need a ton of power, right? Reliable power.
Exactly. They need vast amounts of reliable, often on-site or dedicated, uninterruptible power generation. And that's creating enormous sustained demand for industrial gas turbines. And guess who's the global market leader in the critical hot section turbine blades for those IGTs?
Howmet's using the same single crystal tech.
Precisely. Same core competency, different end market. It's a fantastic diversifier because the demand driver here isn't passenger miles or defense budgets. It's the exponential growth in data and AI workloads. It's a powerful, non-correlated growth engine for them right now.
That's actually brilliant positioning, leveraging their core tech into a completely different high-growth market.
It really is. It acts as a significant buffer against the volatility in commercial aero build rates and leverages their specialized factories very efficiently.
Okay, so diversification helps. But even within commercial aerospace, there's this idea that Howmet can grow faster than just the number of planes being built, the content per aircraft trend. Explain that.
Right. This is a subtle but really important long-term driver for them. Think about how technology evolves. A modern smartphone has vastly more complex and valuable components inside than a simple mobile phone from 20 years ago, even if they're roughly the same size.
More value packed into the same space.
Kind of like that, yeah. In aviation, there's this relentless push for greater fuel efficiency, driven by both economics and environmental pressures, sustainability.
Lower carbon footprint.
Exactly. And one of the primary ways engine makers like GE and Pratt achieve better fuel efficiency is by running the engines hotter and at higher pressures. It improves the thermodynamic cycle.
But hotter, higher pressure means more stress on the components.
Immense stress, which means the components, especially in that critical hot section, need to be made from even more advanced materials, using more sophisticated designs and manufacturing techniques, precisely the kind of complex, high-value airfoils that Howmet excels at.
Ah, so each new engine requires more of Howmet's highest value stuff compared to the engine it's replacing.
That's the essence of it. The dollar value of Howmet's components on, say, a new GE AP engine or a Pratt geared turbofan is significantly higher than on the older generation engines they replace. So even if the total number of aircraft delivered only grows moderately in a given year, Howmet's revenue can grow faster because the value of their content on each new plane is increasing. It's a powerful multiplier effect for them.
Okay, so we've got this picture. Massive long-term demand, but near-term growth is capped by the OEMs. This really puts the spotlight back on what Howmet can control its own operations, its own finances. Let's dig into how they've actually performed financially during this tricky period. You mentioned operating leverage earlier.
Yeah, the financials, especially since early 2023, really showcase this beautifully. Look at fiscal year 2024. Revenue growth was solid, up 12% to $7.4 billion. Respectable, given the environment.
Okay, 12% top line.
But look at the profitability. Adjusted EBITDA,
Yeah.
up 27% to over $1.9 billion. Adjusted earnings per share, it jumped a massive 46%.
Whoa. So profits growing way, way faster than revenue. That's the operating leverage effect in action.
Textbook example. As a manufacturer with significant investments in specialized factories, proprietary machinery, and crucially, that highly skilled workforce we talked about, they have substantial fixed costs.
Right. Those costs don't change much whether they make parts for 30 planes or 35 planes a month.
Exactly.
Yeah.
So as production volumes do manage to tick up, even modestly, those largely fixed costs get spread over more units produced and sold. Each additional dollar of revenue contributes disproportionately more to profit because the incremental cost is lower. That's why you see margins expand so dramatically when volume increases.
And that wasn't just a one-off in 2024. That momentum carried into 2025.
It certainly did. The Q2 2025 results showed record revenue, hitting $2.05 billion for the quarter. And the growth was pretty broad-based. Defense aerospace was up a strong 21%. Industrial and other, which includes that IGT business, was up 17%. Commercial aero was up too, just maybe not as much as they could be doing if the OEMs were faster.
And the leverage continued. Profit growth outpacing revenue.
Yep. Adjusted EBITDA was up 22% year over year in Q2, and adjusted EPS jumped 36%. It just demonstrates this incredible ability they have now to convert revenue growth, whenever it comes, into very significant profit expansion. They're running the machine extremely well.
What's particularly interesting is they achieved this while actively investing in labor, right? Hiring all those people. Normally, wouldn't that hiring and training drag down margins in the short term?
You'd typically expect some near-term inefficiency, yeah. And the sources confirm they've been hiring aggressively, about 1,200 net new employees in engine products in 2024, plus another 360 just in Q2 2025. That's a big influx of people who need to be trained on complex processes.
So why do it now if it creates a drag?
It's a strategic bet. Management is clearly looking at that 15-year backlog and saying, we need the capacity ready for when the OEMs finally get their act together. They're investing ahead of the curve. They're taking the short-term training cost hit now to ensure they can meet the demand that they know with high certainty is coming down the pike. It's often backed by long-term agreements with customers too, so it's somewhat de-risked. They're building the capability even if it means margins aren't quite as high today as they might be if they waited.
That makes sense. A necessary investment for that long-term visibility. Okay, so strong operations, good leverage. How does this translate into cash? Because profits are one thing, actual cash flow is another.
And that's another area where Howmet really shines. They are a cash-generating machine. In FY 2024, they generated $977 million in free cash flow, FCF.
Nearly $1 billion in free cash.
Yep. And they guided for even more in 2025, targeting $1.225 billion. But just as important as the absolute number is the quality of the earnings. Their free cash flow conversion, basically, how much of their reported net income actually turns into tangible free cash, was 88% in FY 2024.
88%, that's very high, isn't it?
Extremely high, especially for an industrial company. It tells you that their reported profits are real, they're backed by actual cash coming into the business, not just accounting maneuvers or working capital gains. It speaks to very high earnings quality.
Okay, so they're generating a lot of real cash. What are they doing with it? Let's talk about capital allocation. How is management deploying that cash flow?
They seem to be following a very clear, disciplined, and frankly shareholder-friendly playbook. Priority number one appears to be balance sheet strength.
Paying down debt.
Consistently. They reduced debt by $391 million in 2024, and then another $76 million just in Q2 2025. This discipline has brought their net debt down to a really conservative level, only 1.4 times their adjusted EBITDA at the end of 2024.
1.4x net leverage. That gives them a lot of flexibility.
Huge flexibility. It means they can easily weather economic downturns, pursue opportunities, and aren't beholden to creditors. It's a position of strength.
Okay, so deleveraging first. What's next? Returning cash to shareholders.
Aggressively. They've been active with share buybacks, repurchasing $500 million worth of shares in 2024, and they'd already done another $400 million through July of 2025. That reduces the share count and boosts EPS. And alongside that, they're growing the dividend rapidly. They actually increased it twice already in 2025, once early in the year, and again announced with Q2 results for Q3.
2 dividend hikes in 1 year signals a lot of confidence from management about future cash flows.
Absolutely. They clearly believe the cash generation is sustainable and reliable, so strong balance sheet, significant returns to shareholders, and then finally they reinvest in the business.
Growth investments.
CapEx. Right. Capital expenditures were $321 million in 2024, and likely trending higher as they build out capacity. But importantly, these investments seem very targeted. They're focused on expanding capacity for the highest demand products, like those advanced airfoils we keep talking about. And often, as we mentioned, these expansions are directly supported by long-term agreements from customers.
So they're not just building factories on spec, they're building them with customer commitments already in hand.
That appears to be the strategy. De-risked growth investment. It's a very balanced approach overall. Maintain financial strength, reward shareholders, and invest prudently for future growth where the demand is clearly visible.
Okay, let's bring this all together. We've painted a picture of Howmet as this really high-quality, best-in-class company. Great margins, strong cash flow, disciplined management, huge moat. The market clearly sees this quality, right? Which leads us straight to the valuation. It's back.
Yeah, steep is putting it mildly sometimes. The market absolutely recognizes the quality here, and the valuation reflects very high expectations. If you look historically, back around the time of the spin-off in 2020, the stock was trading at maybe 11 or 12 times EV to EBITDA.
Kind of a standard industrial multiple.
Pretty normal, yeah. Fast forward to late 2025, and the sources are setting multiples in the range of, say, 35 to 37 times EBITDA in the price-to-earnings ratio. Around 55x.
55 times earnings. Wow. Okay, for context, how does that compare to other big aerospace and defense players like a Northrop Grumman or even GE Aerospace?
It's a significant premium. Those larger, more diversified peers often trade in the mid-teens on an EV/EBITDA basis, maybe 15x, 16x, sometimes a bit higher, but rarely near Howmet's levels. Howmet is trading more like a high-growth tech company or, as you hinted earlier, maybe a capital allocation machine that just happens to make things.
The market seems to be pricing in not just future growth, but like flawless future growth and continued margin expansion for years to come.
That's exactly it. That 55x PE isn't just anticipating recovery. It's anticipating a smooth, rapid, and sustained ramp-up in production from the OEMs, coupled with Howmet continuing to execute perfectly internally, expand margins further, and generate massive free cash flow for the next decade or more. It assumes the bottlenecks get resolved relatively quickly and efficiently.
Okay, so that's the expectation baked into the price. Let's synthesize the bull case then. Why would someone pay that premium? What's the core argument?
The bull case rests on that powerful combination we've discussed. 1. Dominant market position in critical technologies, protected by those incredibly high barriers to entry, the tech complexity, the certification costs, the switching costs. It's a fortress.
Right, the moat.
2. Massive long-term secular growth drivers. You've got the 15-year aircraft backlog, you've got the non-correlated growth in the IGT market fueled by data centers and AI, and you've got the increasing content per aircraft boosting revenue per plane. The demand side looks incredibly secure long-term.
Okay, moat, growth drivers.
3. The superior financial model. Industry-leading margins, fantastic operating leverage, high free cash flow conversion is just a financially excellent business. And 4, proven, disciplined, shareholder-aligned management that has executed brilliantly since the spin-off and allocates capital intelligently. You put all that together.
You get what looks like arguably the best house in a very attractive neighborhood.
That's the bull case in a nutshell. You're paying a premium for perceived quality and long-term certainty.
Okay. But then there's the bear case, and it seems like the primary risk isn't really about Howmet itself, is it? It's almost entirely external.
That's the critical point. The most acute risk, the one that overshadows everything else right now, is that overwhelming dependency on Boeing and Airbus actually being able to build the planes they say they're going to build when they say they're going to build them.
Because of that operating leverage working in reverse?
Precisely. We celebrated how great the operating leverage is when volumes are rising, 12% revenue growth leading to 27% EBITDA growth. But that high fixed cost structure cuts both ways. If volumes stagnate, or worse, unexpectedly dip because an OEM hits another major snag.
Those fixed costs suddenly become an anchor.
A huge anchor. Remember those 1,500-plus highly paid engineers and technicians they just hired in Engine Products? Their salaries are largely fixed. The depreciation on those massive, specialized machines, fixed. If Boeing stays capped at 38 MAXs a month for another year, or if Airbus engine deliveries falter again, Howmet is stuck absorbing all those fixed costs over fewer units shipped.
So if Boeing misses its deliver target by, say, 5 planes next month because of a supplier issue they have, how quickly does that pain show up on Howmet's bottom line?
Almost instantly. Howmet has to build parts slightly ahead of the OEM schedule to ensure they're never the bottleneck. They carry some inventory. If the OEM suddenly slows down the line or pushes out deliveries, Howmet's sales volumes drop immediately, but their cost base, especially labor, doesn't. That leads to underabsorption of those fixed costs, which directly squeezes those beautiful margins we talked about.
So you could see an earnings miss at Howmet that has absolutely nothing to do with Howmet's own performance.
Exactly. It could be entirely due to failures further up the supply chain at Boeing, Airbus, or one of their other key suppliers, like the engine makers. That's the core external risk that the premium valuation doesn't seem to fully account for, or at least leaves very little margin for error on.
And beyond that main risk, we can't totally ignore the underlying cyclicality either, right?
No, you can't. While defense and IGT provide some buffer, the commercial aerospace business, engines, fastener structures, is still ultimately tied to the health of global air travel, which can be hit by recessions. And the forged wheels business is directly tied to the very cyclical heavy-duty truck market. So a broad economic downturn would still hurt them.
Plus things like raw material costs.
Always a factor. They rely heavily on strategic metals like titanium, nickel, cobalt, aluminum. While they have hedging programs and pricing power, significant unexpected spikes in those raw material costs can still pressure margins. And there's always ongoing operational execution risk, especially managing that large, newly hired workforce effectively.
So summing it up, internally, execution risk seems quite low. Externally, the execution risk, particularly from customers, seems extremely high.
That's the dichotomy. The current valuation demands that you believe management can navigate the near-term turbulence caused by the OEM bottlenecks, and that you're willing to wait potentially patiently, for that massive backlog to translate into actual accelerated growth. It's pricing in the long-term potential almost perfectly, leaving little room for near-term disappointments driven by factors outside Helmut's fence line. #tag outro book.
Right. So we've really unpacked Howmet Aerospace. On the one hand, you have this truly best-in-class industrial operator, industry-leading margins, converting profits to cash incredibly efficiently, a deep competitive moat protecting its core businesses, and a clear long-term growth runway.
So what does this all mean? It means you have a company doing almost everything right internally. They're executing flawlessly, investing wisely for that visible future demand. But, and it's a huge but, their actual growth rate, the pace at which they can realize that potential, is fundamentally tied, maybe even throttled, by the performance of their biggest customers. They can only run as fast as the OEM supply chain allows them to.
And we've seen that profitability growth, that EBITDA growth, has consistently run ahead of revenue growth these past couple of years, that operating leverage kicking in. So the fundamental question this leaves for you, the listener, is really this. When you look at that premium valuation, that PE ratio around 55x, can you justify paying that price today? Is the confidence in the long-term high-margin visibility, that certainty provided by the 15-year backlog and the quality of the business, enough to outweigh the very real, tangible risk of near-term growth disappointments caused entirely by factors outside of Howmet's own control? How much patience do you have for the OEM chaos to clear? That's the key risk-reward balance you really need to weigh here.